Hello, welcome to the video about PepsiCo's 2017 annual report discussing Chapter 2 concepts of the classified balance sheet and select ratios. From your text, Chapter 2 Learning Objective 1, we see a classified balance sheet sections. Remember, the balance sheet's a snapshot at a point in time of the resources, the obligations, and what's left for the owners of the firm. The term balance sheet implies an accounting equation that the sum of assets, or the firm's resources, equal its obligations to people who aren't owners, which are liabilities, and what's left over is equity for the owners. To improve understanding and to make easier to calculate ratios, companies group similar types of assets and similar types of liabilities together. For assets, there are current assets, those which will be converted to cash or used up within a year or one operating cycle, whichever is longer. Long-term investments, they could be investments in stocks and bonds of other companies. They could be investments in property that's not being used in day-to-day operation. Property, plant, and equipment are tangible assets. They have physical substance, provide future benefits, and they're used in day-to-day operations. Intangible assets are when firms pay money to buy rights for assets of another company, whether that be a patent, trademark, copyright, or they pay the premium to take over the entire company and have control of it. That's called goodwill. Like assets, there are current liabilities due within 1 year or one operating cycle, expected to be paid, whichever is longer, and there are longer liabilities. The equity left for the owners consists of what the owners put into the business when the firm issued stock, and earnings reinvested in the business. There's actually a few more things that go beyond the scope of this course. So let's get to the real financial report. So this balance sheet, like all balance sheets, starts with assets, and you notice the first section is current assets. It details several types of them. So out of the total assets of $79.8 billion, about $80 billion, $31 billion are current assets expected to convert in cash or be used up within a year or one operating cycle. They're listed according to liquidity, and in the U.S. that means putting the cash first because it's easiest to use to purchase something. Short-term investments next because you can sell investments quickly to buy cash or to convert to cash. Receivables have to be collected from customers before they come to cash. Inventory has to be sold. Then if it's sold on credit, receivables collected. And last of all, prepaid items, because they're not going to convert to cash, but things like prepaid insurance or rent get used up and provide future benefits. PepsiCo has tangible property, plant, and equipment of $17.2 billion. This seems relatively small. How much of this is property? How much of this is plant? How much of this is equipment? You can see so by reading Note 4 of the financial statements. How much is land? And for those tangible assets that have limited lives, you see the amount of depreciation to date. We'll learn more about that concept later. In addition to tangible assets, and it may interest you that it's even more important, is intangible assets include those that are amortizable over a limited life, and that's pretty small, about $1.3 billion. That's when a company pays money to buy another company's patents, trademarks, copyrights, and franchises, or pays money to successfully defend its own patents in court. But the larger part of this is what's called non-amortizable, that have uncertain lives. So a company takes over another company, pays a premium for its net assets over its fair market value. This is called goodwill. Usually if you want to have 1 or 2 shares of a company, you pay the going market price on the stock exchange. To have enough to control the company, you usually have to pay a premium to acquire it. And other non-amortizable intangible assets, again, these have an unexpected life. You can write them down if they're not worth anything later. And then finally, We have long-term investments. If PepsiCo owns stock in another company enough to influence it, let's say 20%, we call these affiliates. They own enough to influence the company to do things it wants. They can get a seat on the board, but not enough to tell them what to do or control them. These are one type of long-term investments. Another type is land not used in operations. On the other side of the balance sheet, assets have to equal liabilities plus equity. Current liabilities for PepsiCo were $20.5 billion, about a quarter of total assets. For the most part, these consist of accounts payable and current obligations like wages payable and taxes payable of $15.1 billion. These don't bear interest costs, but are provided by suppliers, employees, the tax authorities, give you time to pay. Longer-term liabilities come due longer than a year or one operating cycle of $48.3 billion. Most of these are interest-bearing long-term debt obligations. When companies issue bonds or borrow from a bank, there's $33.9 billion. These bear interest expense. There are other liabilities like the amount of unfunded pension plans and deferred income taxes. Total liabilities, $68.8 billion. PepsiCo was nice enough to provide this subtotal for you. If your company doesn't, you can add up the individual liabilities, or you can take total liabilities plus equity, subtract total equity, and the result will be you get total liabilities. So total equity is $10.98 billion. We see contributed capital from shareholders, common stock, and capital in excess of par value. That's about a little less than half of it. And retained earnings, other items when stock has been repurchased, and you will learn a little bit more about these in future chapters. By design, total assets and total equity are the same. Total assets equals the sum of total liabilities and total equity of $79.8 billion at the end of 2017. The reason why this occurs is the way that we record accounting transactions, which you will learn in Chapter 3. The purpose of a classified balance sheet makes it easier to find the subtotals we need to calculate ratios. Liquidity ratios measure the short-term ability to pay maturing obligations and to meet unexpected needs for cash. The current ratio is current assets divided by current liabilities. Classified balance sheet makes this easy to compute. This is for PepsiCo at the end of 2017 and 2016. If you divide current assets of $31 billion divided by $20.5 billion, we get a current ratio of 1.5 to 1. In 2016, this ratio is a little bit lower, or 1.28 to 1. For every dollar of current liabilities, Pepsi has $1.51 in current assets, so it has a little extra left over and on hand. At December 31st, 2016, it only had $1.28 in current assets for every dollar of current liabilities. That means PepsiCo would be more liquid or more able to meet unexpected needs for cash in 2017. Some firms have very low liquidity, but the ability to borrow money quickly under lines of credit. Solvency ratios measure the ability of a company to survive over a long time, to repay debt obligations, and the risk of their financial structure. Debt to assets ratio gives us total liabilities, both those that are interest-bearing and those that are not, divided by total assets. Classified balance sheet again will make this easier. PepsiCo was nice enough to give you a subtotal for total liabilities of $68.8 billion. Divide that by total assets of $79.8 billion. You see the debt to total assets ratio is 86%. Not too much different than the ratio in 2016. What this means is for every dollar of assets that Pepsi controls, it financed it by using 86 cents of other people's money, creditors, some of whom require interest payments, and some of whom are trade creditors, like suppliers or employees that don't demand to be paid in cash in every day. The 2016 ratio, every dollar of assets financed by 85% of debt. PepsiCo slightly less solvent in 2017 because having more debt implies more risk. As you know, perhaps with one's own student loans, if you have student loans, you have obligations you have to meet even if you lose a job or have a financial reversal. So debt can make you better off in the long term, make you have higher earning jobs if you're a student borrowing money, make you able to invest in profitable opportunities if you're a company, but there is the risk of having to pay them back if you have economic down periods. So having more debt is risky. Please feel free to use this presentation as a review before calculating the current ratio and debt to assets company for the chosen company for our discussion in week 1. Good luck. Get started, Jaspers.